The U.S. Securities and Exchange Commission's long-anticipated rule on securities tokenization has sparked intense debate, particularly after reports suggested it might allow synthetic tokens. This rule, expected to reshape financial markets through tokenization, has become a focal point for speculation. SEC Commissioner Hester Peirce, known for advocating a more flexible regulatory approach to crypto assets, recently addressed the issue directly. In 2 consecutive public statements, Peirce clarified that the new rule will not support synthetic tokens. Synthetic tokens are digital assets that mirror the value of an underlying stock, but do not grant ownership rights or voting privileges. Peirce emphasized that the rule will only cover digital representations of actual securities currently traded on secondary markets. This means investors will be able to tokenize real stocks, but synthetic versions created by third parties will not be permitted under the new framework. The clarification came amid growing speculation, fueled by a recent Bloomberg report suggesting the SEC might allow synthetic tokens to be traded on decentralized platforms. Peirce thanked the public for engaging in the conversation, but urged caution against overinterpreting the early signals. The distinction between real and synthetic tokens is crucial for understanding the regulatory implications. Real tokens represent actual. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Ownership of a financial asset and are backed by the same rights as traditional securities. Synthetic tokens, on the other hand, are algorithmically tied to the price of an underlying asset, but do not confer any ownership or legal rights. This distinction is central to the SEC's decision to exclude synthetic tokens from the rule's scope. The move has significant implications for market participants who had been preparing for a broader tokenization framework. Developers and exchanges had been exploring ways to tokenize not just real assets, but also synthetic versions that could represent a wider range of financial products. Peirce's statements suggest that the SEC is focusing on real tokenization, not synthetic constructs. This could limit the scope of innovation in the space, but also provide clearer legal boundaries for market actors. The debate over synthetic tokens has intensified in recent weeks, with industry players and analysts closely watching the SEC's direction. The agency's decision to clarify the rule's scope now, rather than waiting for finalization, indicates a desire to manage expectations and reduce confusion. For investors, the message is clear. The new rule is not a green light for synthetic token trading. Instead, it is a framework for tokenizing real securities in a regulated manner. The next signal to watch is the final rule's publication date and whether any changes will be made in response to industry feedback. The SEC's approach to synthetic tokens could also influence future regulatory decisions on other types of crypto assets. As the market digests Peirce's statements, the focus will shift to how exchanges and platforms adapt to the new framework. The exclusion of synthetic tokens from the rule's scope could lead to a bifurcation in the market, with real tokenization gaining traction while synthetic constructs remain in regulatory limbo. The SEC's position also raises. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Questions about how it will handle other forms of crypto assets that blur the line between real and synthetic. The agency's stance on synthetic tokens may serve as a precedent for future regulatory decisions in the crypto space. Investors and developers will need to monitor the SEC's actions closely to understand the evolving regulatory landscape. The next signal to watch is whether the SEC will issue additional guidance or if market participants will push back against the exclusion of synthetic tokens. The final rule's release will be a key moment for clarity and could shape the future of tokenized financial markets.